Ever walked into a store and wondered, how did they actually figure out their profit? I mean, the price they pay for stuff is always changing, right? One month a t-shirt costs them $5 to buy, the next it's 6. So when you buy it, which costs do they use? That little puzzle is exactly what we're going to unravel today.
So here's our game plan. We'll kick things off with the basics, what inventory even is, and how it travels through a company's financial reports. Then we get to the main event, the different ways companies account for inventory costs. After that, we'll see why this choice has a huge impact on profits and taxes. And we'll wrap up by looking at how companies value what's left on the shelf and measure how fast they're selling it. Ready? Let's get into it.
Okay, first things first. Let's trace the journey of a product. From the moment it's sitting in a warehouse to how it shows up in the company's official financial statements.
At its heart, inventory is just all the stuff a company plans to sell. But here's the key thing from an accounting perspective. When a company buys or makes this stuff, it's not an expense right away. Nope. It's actually considered an asset on the balance sheet. It's something the company owns that has future value.
So just imagine a giant warehouse full of products. All of those boxes, all those items on the shelves, they're all sitting right here on the balance sheet as a current asset called inventory. It's a resource just waiting to make the company money.
And here is where the magic happens. The second an item is sold, poof, its cost makes a journey. It leaves the balance sheet and lands over on the income statement as an expense. We call this the cost of goods sold, or COGS for short. This is a beautiful example of a core accounting idea called the matching principle. You match the expense of an item directly with the revenue you got from selling it.
And that brings us to this super important formula. Gross profit is the money a company makes just from its core business of buying and selling stuff, before all the other operating expenses. For anyone, investors, managers, you name it, this is one of the very first numbers you look at to check a company's health. So you can see why getting that COGS number right is absolutely crucial.
Now, inventory isn't a one-size-fits-all term. It can look pretty different depending on whether you're, say, a retail store or a company that actually builds things from scratch.
For a retailer like Target or Best Buy, it's simple. They buy finished products and sell them. That's just called merchandise inventory. But for a manufacturer, it's a whole process. They start with raw materials. Think lumber, steel, plastic. Then, as those materials are being assembled, they become work in process. And only when the product is fully built and ready to ship does it become a finished good. 3 stages, 1 final product.
So this brings us to the core puzzle of inventory accounting. If you buy the same widget 3 times this year and the price goes up each time, which cost do you use when you sell one? And believe me, the answer to that question matters a lot. Let's make this real with an example. Meet Butler Company. They started the year with 500 units that cost them $100 each. But look what happened. Prices started rising. In March, they paid $150 a pop, and by October, a whopping $275. So, they sold 700 units during the year. The big question is, what was the actual cost of those 700 units?
Well, to solve this problem, accountants use something called cost flow assumptions. And here's the thing, these are just accounting methods. They don't have to match how the actual physical products moved. There are 3 main ways to do it: FIFO, LIFO, and average cost. We're going to focus on FIFO and LIFO because they show the most dramatic difference. Okay, let's start with FIFO. It stands for first in, first out. Just think of milk at the grocery store. You sell the oldest ones first. So to get our cost for the 700 units sold, we assume we sold all 500 of those oldest units at $100 each. Then we need 200 more. So we take them from the next batch we bought, the ones at $150. Add it all up, and our cost of goods sold is $80,000. That leaves our newest, most expensive inventory still on the balance sheet.
Now for LIFO, which is the complete opposite. Last in, first out. Think of this like a stack of logs. You grab the one on top first. So here we assume we sold our newest inventory first. We take all 200 units from October, then all 300 from March, and then we dip into our oldest January inventory for the last 200. And whoa, look at that. The COGS skyrockets to $120,000, and we're left with the oldest, cheapest stuff on our books. That is a massive $40,000 difference in COGS just based on an accounting choice.
So you're probably thinking, okay, a $40,000 difference, so what? Well, this is where it gets really interesting, because this choice has huge real-world effects on a company's profit and, maybe most importantly, how much it pays in taxes.
This slide really breaks it down. When prices are going up, like in our example, FIFO gives you a lower cost of goods sold. That means your reported profit, your net income, looks higher. Great, right? Well, the downside is you pay more in taxes. LIFO does the exact opposite. Your COGS is higher, so your net income is lower, and here's the kicker. That means you pay lower taxes. This tax savings is a huge reason why some companies in the US choose to use LIFO.
Now, companies that use LIFO have to report this thing called the LIFO reserve. You can think of it as a what-if number. It tells everyone, hey, if we had used FIFO, our inventory would be worth this much more. It's a really useful number for analysts because it basically quantifies the tax deferral the company has gotten over the years just by using LIFO.
All right, let's wrap up with two final, really important ideas. It's not enough to just track the cost of inventory. You also have to make sure it's actually worth what you paid for it, and you need to know how efficiently you're selling it.
There's a rule in accounting called conservatism. Basically, you don't want to overstate how well you're doing. This rule, the lower of cost or NRV, means that if your inventory's market value drops below your original cost, you have to write it down. Maybe the product becomes obsolete or damaged. That write-down becomes an expense, and it actually increases your cost of goods sold for that period.
So how do we measure how good a company is at managing its inventory? One of the best tools is a ratio called inventory days. This formula tells you, on average, how many days it takes a company to sell its entire inventory. And usually a lower number is way better. It means your products aren't just sitting on a shelf tying up cash.
And to put that into perspective, check out this number for Apple. On average, it takes them just 14 days to turn their inventory into a sale. 14 days! That's just an incredible level of efficiency. It's a sign of a company that has mastered its supply chain.
Phew, we have covered a ton of ground here. So let's just take a quick pause and boil it all down to the absolute must-know takeaways from this whole explainer.
Okay, here's the bottom line. 1. Inventory starts as an asset and only becomes an expense, COGS, when you sell it. 2. Your choice of FIFO or LIFO isn't just for the accountants. It literally changes your profit and your tax bill. 3. When prices are rising, LIFO can save you real money on taxes. 4. You can't just keep inventory on the books at its original price forever. You have to write it down if its value drops. And finally, number 5, inventory days is a powerful little metric to see just how well a company is running its business.
And I'll leave you with one last thing to chew on. We've seen how LIFO can be a big tax advantage here in the US. So why is it completely banned under international accounting rules, which most of the world uses? It's a really fascinating question about the trade-off between saving money on taxes and, well, maybe presenting a more accurate picture of a company's performance. Something to think about. Thanks for tuning in.